Okay, this is the test review for accounting, chapters 1 through 5. If it were me, I would pull out a piece of paper and I would take some notes. And then between now and the test, I would spend some time in the textbook over the first 5 chapters looking at it. And then, of course, you can go on my website and listen to the review if you'd like to. It's a slightly different review. And so the combination of this review, my other website review, and the 5 chapters in the textbook, you should be thoroughly prepared for this test. Okay? Just so you know, the test has 50 multiple choice questions on it. And it's over the entire accounting cycle. So let's begin by quickly reviewing the steps of the accounting cycle. This fits perfectly into the review problem that you're currently working your way through. So what's the first step of the accounting cycle?
Collect source documents.
To collect source documents. And Will, what are source documents? What are the source documents? Give a couple of examples of source documents that we use to help us do the transactions.
The income statement, balance sheet.
Invoices.
Those are financial statements. The source documents are?
Invoices, check stubs, receipts, memos.
Excellent. All the different materials that we use to keep track of what's happened financially in the business. The biggest single is check stubs. That's the biggest single source document. Source documents, but receipts and invoices, deposit slips, all those things. We keep track of all those things. We file those away. Those are called source documents. Very important. That's why we don't want owners to take money right out of the till and just go buy something for the business, because there isn't what we call a paper trail. We need to have good documentation of everything that happened. If he takes $30 out of the till, we tell him, do not do that unless you take a piece of paper, write down that I took $30 out of the till and I'm going off to buy such and such for the business. What's that called, that little piece of paper? That's called a chit. C-H-I-T, a chit, or a memorandum. And so anyway, so we need to keep track of all the chits, okay? Anyway, all right, so first step is to source documents. Then the second step, of course, is to journalize. What can you tell me about journalization?
Goes inside the journal.
There you go. The journal is the book of original entry. Every single thing that happens and affects the business financially ends up in the journal. Nothing happens in the other books, like the ledger or on the reports or anything, unless it's put into the journal. The journal is the book of original entry. Everything goes through the journal. That's the door into the accounting cycle, or into the accounting books. So we journalize, correct? And then when we journalize, a couple of rules that we remember is that every single transaction that we journalize always has at least one debit and one credit. Right? At least one. What do we call transactions that have multiple debits or credits? Those are called compound transactions. You can have more than one, but you have to have one of each at least. Debits will always equal credits. Always. After we journalize every once in a while throughout the month. Now, during the month, all we can do is journalize, keeping track of the transactions. Doesn't matter if it takes up 3 pages or if it takes up 8 pages or 23 pages of journal. We just keep track of all the transactions. Occasionally, when we have quite a few journal entries, we will post those entries, the journal entries, to the ledger through the process called posting. That's the next step. We post it to the ledger. We generally don't want to wait till the end of the month, unless we don't, depending on how many transactions we have. What's the purpose of the ledger?
Keep balances.
To keep track of the balances in each account. Every single account in the chart of accounts has a separate ledger. And remember, how many categories of accounts do we have? 5. Braden, what are they? What's the first category of accounts? Assets. Assets is a category. Cash is an account under the asset category. So we have assets, liabilities, owner's equity, revenue, and expenses. Those are the 5 categories of accounts. Underneath those categories, we have a variety of individual accounts, and each one has a separate ledger that we keep track of, because we need to keep track of the balances in each one. You'll also remember that certain ledger accounts have a debit balance, and certain ones have a credit balance. The debit balances are what? 2 out of the 5 categories have debit balances. Those would be assets and expenses. The other 3 have a normal credit balance, okay? So all month long, we are journalizing the transactions, and we are posting them occasionally to the ledger. That's all we can do all month long. In the first day or 2 of the next month, then we can rush ahead and do all of the rest of the steps of the accounting cycle. The next step, after we've journalized and posted everything, what's the next step? We fill out the worksheet, correct? By doing a trial balance in the first 2 columns. Then we do adjustments, which we'll talk about. After we've created all the adjustments on the worksheet, then we do an adjusted trial balance, verifying that debits still equal credits one more time before we create the reports. How many reports are there that we do? 3. And we always do them in order, because we need the information from the first one in order to do the second one. The first report that we always create is the income statement. Income statement. Second one is the statement of owner's equity. And then the last one is the balance sheet. Correct? Now, once we have done that, once we've journalized everything and posted everything, finished the worksheet and created the 3 reports, we run to the owner and we hand them the 3 reports, because they are anxious to get them. They want them right away. Remember, the key to good reports, there are 3. What are the 3? Reports have to be timely, as fast as we can get them to them, accurate, and complete. The more complete and the more accurate they are, the better they are. We don't certainly want our managers and owners of businesses to make bad decisions based on the reports we provide them. So they're happy, they run away with their reports, and then we go back, and then we have to clean up the books and get it ready for the next fiscal period. When I say cleaning up the books, what I mean are the last 3 or 4 steps of the accounting cycle. Number 1, to record or journalize the adjustments. We have to do that. We have to take those adjustments from the worksheet and put them in the journal, and then post them to the ledger, so that those ledger balances equal what we told the owner he or she had. So those adjusting entries become rather important. After the adjusting entries, we only have 2 other steps. The 2 final steps of the accounting cycle would be to record the closing entries in the journal. Remember, everything goes in the journal. We record them in the journal, and then we post those to the ledgers. And what's the purpose of the closing entries?
One last trial balance.
I'm sorry, what?
One last trial balance.
Well, no, what's the purpose of the closing entries? Why are we closing out things?
To zero out accounts so we don't accumulate all those.
Good. We have to, every fiscal period, we have to take the temporary accounts to 0. We want to make sure that we start each fiscal period with a whole bunch of different accounts at 0. The ones we want to keep track of, just fiscal period to fiscal period. Those include the revenue accounts, the expense accounts, and the withdrawal or the drawing account. We have to close those out so that they start at 0. And we do that by performing the closing entries. The other thing the closing entries do is to adjust the capital account by the amount of the net income and the withdrawals. And we'll talk more about that as I get into specific questions on the test, okay? Final step of the accounting cycle is, final step,
Post-closing trial balance.
the post-closing trial balance is correct. That's a rather short one because all of the accounts at zero, which is all the expense accounts, all the revenue accounts, those don't even show up on the post-closing trial balance. We only put the accounts that actually have a balance, and those would be the permanent accounts. Basically, they're the accounts that show up on the balance sheet. The balance sheet are permanent accounts, the income statement are the temporary accounts. Fair enough? All right, so with that review, with that summary of what we've done thus far, let's go through some specific questions, okay? What is the difference between an account and a category of accounts? If I said, is equipment an account or a category? It's an account. What if I said accounts payable? Is it a category or an account? It's an account. What if I said rent expense? It's an account. What if I said liabilities? That's a category. Okay? And remember, on the chart of accounts, we list the 5 categories, and in under each category of accounts, we list the individual ledger accounts, and they have a number, don't they? And we always list asset accounts first, and they always have 100 numbers. So we have 100, 200, 300, 400, 500 numbers. So a 500 number account is an expense account. A 400 number is a revenue account. Okay. Let's see. Now, on this test, a lot of the times what they use, instead of using debit or credit, they use increase or decrease. Is that easier or harder for you? Should be easier. I hope it should be easier. All right. What do we call money owed to you is called what? Where would you put money owed to you? Accounts receivable. That's exactly right. What kind of account is that? Under what category?
Asset.
It's an asset account. It is an asset account. The normal balance of an asset account is a debit. Accounts receivable generally will either be at zero or it will have a balance in it and it will have a debit balance. Okay? All right. Accounts receivable is money owed to you. Money that you owe is called accounts payable, money that we have to pay. Receivable and payable. Okay. Let's see. There are only 2 ways to record revenue. Tell me what they are. What? 2 ways to record revenue. Let's say you mow my lawn. What are the 2 choices? How would you record?
Pay now or pay later?
Pay now or pay later. If I pay now, what will you have? What will the transaction look like?
Cash.
You will debit cash and credit revenue, right?
Yeah.
That's if I pay you. If I don't pay you, then what do you do?
You debit.
accounts receivable.
Yes, obviously you put it. Then I owe you the money. If I don't pay you the money, I owe it to you. You've earned the revenue as soon as you've mowed the yard. That's the key. In either case, you're going to credit revenue, but you're going to debit cash if I pay you, or you're going to debit accounts receivable if I don't pay you. Then 2 weeks later, I send you a check, and I pay you. What's the transaction?
Credit accounts receivable and debit cash.
You always talk about the debit first, but you debit cash, because now you run to the bank with my check and you deposit it. You debit cash and you credit accounts receivable. You take it, and now I don't owe it to you anymore. So now you're decreasing accounts receivable. Notice something very interesting. When I pay you a bill that I owe you, you do not touch revenue again, do you? You only record it as revenue one time when you bill it. That's important. Otherwise, your revenue would be overstated, wouldn't it? All right. Let's see. You go out and you buy a forklift. And you charge it. You buy it on account, as we call it. How does that affect the books? How does that affect the accounts?
Debit equipment or whatever account you have set up credit, accounts payable.
Correct. You're going to debit the equipment. I now have more equipment in the company. Is that an increase or a decrease? That's an increase. We're increasing an asset, and then we are going to credit accounts payable. Are we increasing or decreasing it? What? We're increasing it. This is the tricky part of this. The reason we use debits and credits and not increases and decreases or something is because people would think automatically that if you have one increase over here, you got to have a decrease someplace. That's not true. Not true. Many, many times we will have both of those are increases. It just so happens that when we increase an asset, it's a debit, but when we increase a liability, it's a credit. So debits and credits equal. But you can have two decreases, or you can have two increases in a transaction, or you can have one of each. So don't get confused. Don't think in your mind, well, I have to have a decrease and an increase. No, that's not true at all. Okay? Very good. All right. So let's say that your business, you open up your mail this morning, and you have $350 worth of checks from customers who owed you money. Okay? What is the transaction? What gets increased and decreased? This test requires, you know this stuff. Every one of you can do very well on this test, I guarantee it. If you just sit back and think about it before you sometimes you just answer the question too quickly and you don't thoroughly think about it. When customers are paying off bills that they owe you, what gets increased, what gets decreased?
Cash gets increased,
Cash gets increased.
and then accounts receivable gets decreased.
Correct. Another way to say it would be one asset increases and one asset decreases. Make sense? So on a test like this, they'll say an increase in an asset, an increase in revenue, an increase in an asset and a decrease in capital, an increase in an asset and a decrease in liability, or an increase in an asset and a decrease in an asset. What's the answer? Increase in an asset and decrease in an asset. And of course on this test they have 5 distractors on every question, 5 potential answers, not 4. And on this test they love to put none of the above or all of the above. I don't like those kind of questions generally, but the test is the test, okay? Any questions about that? So start thinking in your mind. One of the key things you'll need to remember is a debit an increase or a decrease in this account? And of course the answer is it depends on what account it is. This test is full of increases and decreases. That's the wording they use. There is some debits and credits, but they're mostly increases and decreases. Okay? Let's see. No, somebody starts a business and they put $8,000 into an account to start the business. How do you record that transaction? Go.
You debit cash.
Good.
You credit capital.
Excellent. Is that an increase or a decrease?
Increase.
In both cases, it's an increase, isn't it? Very good. All right. Let's see. Good morning. Here's an interesting question. If you buy supplies for cash, you go out and buy $200 in supplies. What's the transaction? What do you debit? Supplies. And what do you credit? Cash. What has happened to total assets? Nothing. There's no change to the total assets. All we've done is transfer or switch one asset for another asset, right? We have less cash, but we have more supplies. So the total asset doesn't change at all. If you totaled up all the assets, it wouldn't change. That may not sound right, but that's true. All right. Let's see. If you bought supplies instead of with cash, if you bought it on account, what's the transaction? What's the debit? Supplies. What's the credit? Come on, everybody, you should be able to, accounts payable. Remember this, there's only two ways to buy anything. Either you pay cash for it or you owe it. Those are the only two ways. So it's either going to be crediting cash or it's going to be crediting accounts payable. That's the only choices. There's only two ways to sell something. Either somebody pays you for it or they charge it with you. So it's either cash, debit to cash, or you're going to debit accounts receivable. There's only two ways to do either of those, okay? How do you find an error? If you have an error in the trial balance, what kinds of things would you do to try and find where the mistake is? What's the first thing you would do? Come on. This isn't rhetorical. What do you got? What's the first thing you'll do if your numbers don't balance? No. It's not check the answer book. How dare you? The first thing you would do is re-add your numbers, right? How many times have you made a mistake just by totaling up a column? Happens a lot. What's the next thing you would do? If you add them up again and again and it still works, it still doesn't balance. Obviously, one of the things you do is you look for making sure that you accurately brought numbers over from the ledger into the trial balance. It's very easy to bring $174 in the ledger over as $147. That's called transposing the numbers. And if you do that, the other thing you want to look for is numbers that you failed to bring over. Maybe you forgot or you overlooked one of the accounts, right? So there's a number of them. You check the footings and you verify figures, so anyway, those are all different things you look for, okay? Remember this, if your trial balance balances, if debits do equal credits in the trial balance, are you sure, positive that you didn't make any mistakes? No, you're not. There are some kind of mistakes that still could have been made. Maybe you've skipped an entire transaction. Or maybe you put $150 in the wrong account, but it still balances because whether it's cash or accounts receivable, it would still balance. Does that make sense? So there are mistakes that will not be caught in the trial balance. Let's see. If you buy $35 worth of supplies, but for some reason you record it in the journal as $45, what is the effect of that? I can't hear you. What?
Increasing
Well, it does increase. What we call that is it will be overstated. We will say we have $45 worth of supplies when we don't. We only have 35. That's called overstating the balance. Okay? All right. And of course, cash would be understated in that case. If we debited supplies for $45 and credited cash for $45, and we only really spent $35, then our supplies would be overstated and our cash would be understated. Right? Okay. Prepaid insurance. What kind of account is prepaid insurance? It's an asset account. It's something of value. Okay, very good. Let's see. I already talked about that. Now there are some calculations on the test. They give you some numbers and you have to calculate some things. So you are able to use a calculator on this test, okay? Revenue. What are the different kind of ways that you can record revenue? Cash, checks, credit card receipts. What else? And credit sales to charge customers. Those are all revenue, right? When I say credit sales to charge, that means somebody buys something on account. That's revenue. They also can pay by check, they can pay by credit card, or they can pay with actual dollar bills. Okay? What is the fundamental accounting equation?
Debits equal credits?
No.
Assets equals.
That is an equation, I guess, technically, but it's what?
Assets equals liabilities plus owner's equity.
Assets equals liabilities plus owner's equity. Okay, that is called the fundamental accounting equation. Let's see if there's anything else here. No? Nope. Okay. Let's see. Which accounts have a normal credit balance? Which accounts normally have a credit balance?
Capital,
Capital,
revenue, and liability.
revenue, and liabilities. Those are the credit balance categories of accounts. That's correct. Is there an exception to that?
Well, drawing.
The drawing account is the unusual one. That's the red herring, as they say. That's technically an owner's equity account, but it operates very much like an expense account, even though it's not an expense account. That will have a normal debit balance. Okay, let's see. We've already talked about that. A debit increases what kind of accounts? A debit increases. See, these are all the same kind of questions. They're just worded a little different. And if you'll just stop and think about it, and you kind of look at, if you ask a question like that, kind of visualize a journal page or visualize a ledger, and you can figure this stuff out. What accounts increase by a debit? Go.
Assets
Yes?
and expenses.
And expenses. Correct. And the drawing account. That is correct. And a credit would decrease those, right? Okay. Let's see. You guys should do very well on this test. I will smack you around if you don't. Cross that off. I don't want that on the video. Okay. Let's see. What accounts get listed in the trial balance?
All of them with a balance.
Correct. Is there anybody who can speak other than Justin? I'm just checking. You've said a couple things, George. Thank you. All right, so yes, we only include those accounts that have a balance in them, in the trial balance. We don't include all the accounts with zeros. Okay? All right. What's the normal balance of an account is on what side? If you think, the answer to this question, if you think about T accounts, the normal balance of an account is on the plus side. I know that's a chintzy question. I'm not a big fan of that question because it's kind of goofy. But if you think about T accounts, one side is a plus, one side is a minus. All right. Generally speaking, if you think about it, the normal balance is the side that you're adding things to. Assets, you add debits, so therefore it has a debit balance. In revenue, you add credits together, and so normally it has a credit balance. It's the side you're adding to, okay? Let's see. Pretty straightforward. Okay. No problemo. Let's see. Tell me about explanations. Where do explanations go?
In the journal.
In the journal. And what is the purpose of the explanations?
Do you know what you spend money on or got money for?
I think I understood you, and I think that is sort of correct. The explanations are to clarify what the transaction, correct? We want the journal to be fully understandable in and of itself. As I said to you before, if somebody found a journal from 500 years ago, if it was properly done, they could reconstruct all of the reports on a monthly basis. They could tell you exactly what took place for the entire life of the business if they found a properly executed journal. So on the explanation line, we talk about the check number maybe, we talk about who we owe money to. If we buy something on account, we have to list the person we owe money to. So we write that in the explanation so that we can keep track. Now, eventually we'll go to the ledger and create an accounts payable for that vendor. But the explanations are important. Are there any transactions that do not require explanations? My answer to that question is yes. If the journal entry is completely self-explanatory, then it probably does not require an explanation. However, it's not a bad idea. I assume there are some accountants that put a small explanation on every journal entry. I don't know. If I paid the rent with a check, that's a very self-explanatory transaction, isn't it? Rent expense, debit, credit, cash. Now I might put down as an explanation what month I was paying the rent. Paid rent for October 2011 or November. Maybe I would say that. I don't know. But if it's a totally self-explanatory transaction, it probably doesn't need a full explanation. Okay. What's the proof that debits equal credits in the ledger? What is the proof of that? See how the wording is weird? What do you think the answer is? The proof that debits equal credits is the trial balance. Does that make sense? Cammie? Nod your head. Good girl. Okay. All right. A couple of questions on the test talk about correcting entries. A correcting entry, if you realize you've made a mistake and you've already moved forward 3 pages and you find a mistake back on page 27, then the proper way to do it is not to just erase it with a pencil eraser. The proper way to do that is to journalize a correcting entry, right? So let's pretend that we bought supplies for $53. So but we made a mistake and we journalized, instead of 53, we journalized it as 35. We transposed the numbers. We debited supplies $35, we credited cash $35. 2 weeks later, we're going through our check stubs and we realize, wait a minute, I show $35 check and it really was a $53 check. So we have to put in a correcting entry. And the correcting entry in that case would be to increase our supplies. We would have to debit supplies by the additional amount that we bought, and we would have to credit cash by the additional amount of the check. Make sense? And we write correcting entry, see, November the 8th, see, and then our ledger account would be in balance, correct? Okay. Book of original entry is the journal. Let's see. If the owner of the company called me and said, Kane, how much cash do I have right now? Where in the journal would I find that information?
The journal or the ledger?
I wouldn't find it in the journal. That's the trick question. Yeah. Where would you find the balance of the cash? In the ledger. Now you might have to say, at middle of the month, you might have to say, well, hey, listen, sir, I have to let me post, let me do some posting here, and I will get you the balance, because right now the balance in the cash is not up to date. Does that make sense? Because we only post to the ledger every once in a while, so we might have to do some posting in order to have the exact balance. Make sense? Okay. Let's see what else there is. All right. There are some questions that you're just going to have to look at, you're going to have to study out in your mind, and you're going to have to contemplate and think about it before you answer. Because you have to look at every potential answer and see if it rings true or not. Just get good at visualizing journal pages, visualize the income statement, and so on and so forth, okay? All right, moving on. Okay, here we go. There are some types of assets that as we use them up, we expense them. What are those? Name some.
Supplies.
Supplies,
Insurance.
prepaid insurance. What else?
Equipment.
Nope. Well, we don't strictly just expense them. We depreciate those. Okay? That's the difference. What makes the difference between the assets that we depreciate versus the assets that we expense? It has to do with how long the asset's going to last. If it's going to last a year or more, we generally depreciate it, okay? Now, how do we depreciate? What's the methodology? If you say again?
Put it as adjustment, and then you go in and you put it and adjust the trial balance.
Good. Every fiscal period, we will make an adjustment for the equipment that is losing value because of depreciation. Our truck is wearing out. Every month, our truck is worth less than it was last month. That's the nature of it. Okay? So let's say we bought the truck for $10,000. And over the last 3 years, we have depreciated it. We have accumulated the depreciation against the truck to the tune of $4,500. And that's in the accumulated depreciation. If you remember on the balance sheet, we show the truck as a $10,000 asset, and then we subtract the accumulated depreciation against the truck. $10,000 truck, $4,500 of accumulated depreciation. How much is the truck worth today?
$66,500.
Well, $5,500, right? The remaining value is $5,500. What do we call that $5,500? That's called book value. That's the book value of the... It's not how much you paid for it. If I was going to buy you a business, I don't care that that piece of equipment cost you $100,000 10 years ago. What I care about is how much is it worth today. And I would ask the question, what is the book value of that piece of equipment? Does that make sense? Yeah. Okay. All right. Accumulated depreciation is what kind of account?
Assets. Accumulating depreciation.
Accumulated depreciation is what kind of account? It's actually a contra account. A contra account is an account that is, well, contra, meaning it's kind of a device we use in accounting. What's the normal balance in accumulated depreciation? Credit. It's a credit balance. Month after month, we are accumulating that depreciation in that account. That's why it's called accumulated. That is a permanent account. We don't zero that out. Okay? It's a contra asset account, they call that. A contra asset account. Because it operates opposite of a regular asset account. What is the adjusting entry to record depreciation on equipment? Come on, this is not that hard. What do we debit? Oh, gosh. What? Exactly right. We are going to debit depreciation expense, comma, equipment. That's the debit. The credit is accumulated depreciation equipment. And that credit accumulates because, but if we're reducing the value by $350 this month, that is actually an expense of the business. So every month we get to depreciate that as an expense and write that expense off. Make sense? The only difference really with depreciation is instead of just deducting it from the value of the asset, we accumulate it in a depreciation account and then subtract it from the balance, from the value of the asset. Okay? All right. All right. How would you define depreciation? Depreciation is the loss of usefulness in an asset. The loss of usefulness. Every asset has what we call an economic life. And as an asset uses its life, or uses up its life, it is becoming less valuable, right? Because it is less useful. I don't know about you, but my 8-track player is not very useful anymore. I have a box at home of records, regular vinyl records. I don't even have a turntable anymore. I don't know why I'm holding on to the records, because I'm an idiot. But that's not the point. The point is they aren't very useful to me right now. I could hang them up on the wall as art, maybe, but I can't play them musically. How dumb is that? But I've moved 3 or 4 times, and I just carry those boxes of records everywhere I go. I just can't bring myself, Marissa, to get rid of them. It's unbelievable. All right, let's see here. Let's see. Okay. What's the adjusting entry for prepaid insurance? Let's say we have, I don't know, let's say we have we buy an insurance policy for $360 for the year. Every month we're going to use up some of that prepaid insurance. How much are we going to use up every month? If it's $360 for the year, it's $30 a month, right? So every month we are going to make an adjustment on the worksheet. What are we going to debit? Insurance expense. Insurance expense for $30. What are we going to credit? Prepaid insurance. Why? Because the insurance is going to be all used up in a year, and so we just expense it that way. Okay? All right. What's the trickiest adjusting entry that we've dealt with so far?
Wages payable?
Yeah, wages. I think the wages thing is a little tricky. When a fiscal period crosses over or falls inside of a pay period, we have to make an adjustment for the amount of payroll that we owe that has not been paid yet. We want to make sure that your wages on November 30th are applied to the November fiscal period. It has to be done. Even though we're not going to pay you until the beginning of December maybe, that day, November 30th, has to be applied to the November fiscal period. The way that we do that is by making an adjustment. And that adjustment, we will debit the salary or the wages payable, the wages expense, we'll debit wages expense, and we'll credit wages payable because we owe the money. And then the next pay period, when we pay it, we will deduct, we'll get rid of it by debiting wages payable. Okay? Questions about that? Some of you are looking at me like you've never heard anything about accounting before. You don't know why you're sitting here. You guys okay? All right. All of the things that we're talking about, you are doing in that review problem, aren't you? It's fantastic. It's perfect. It's almost like it was planned. Okay. What's the word for wages that you've earned but I haven't paid you yet? What do we call that? Well, it's wages payable, but what's another word for it? It's called accrued. The word is accrued wages. A-C-C-R-E-D, accrued. Those are wages that have been earned but have not been paid. Don't fade on me in the last 15 minutes, people. All right. Closing entries. What are the 4 closing entries in order? Quickly.
Revenue, expenses.
We close out the revenue account by debiting revenue. The second closing entry, we close out all the expense accounts by crediting the expense accounts. Third closing entry.
Drawing.
Third closing entry, we adjust the capital account by the amount of net income or net loss. That capital account has to be accurate. We've already reported the accurate number in the report. Now we have to go back and fix the ledger. That's the third closing entry, which is technically an adjusting entry, sort of. The fourth closing entry is where we close out the drawing account. How do we close out the drawing account? What's the fourth closing entry look like? What do we debit? Come on. What do we debit? Capital. We debit capital. We're going to reduce capital. If I take $1,000 out of the business in drawing, that reduces my capital by $1,000. So I will debit capital and credit the drawing account. That will bring the drawing account to zero, and it will reduce my capital account by the amount I took out of the business. It's perfect. It's elegant. It's perfect. It's beautiful. Okay? All right. So, on a test like this, I might add, which of these accounts is never involved in closing entries? Does that make sense? And then they list 5 different things. 4 of them are involved. 1 of them is not. And you have to say, oh, that one, I never put that in the closing entries. I'm not going to put an asset account in closing entries. We're not going to close out our supplies account or our cash or accounts receivable. Then nobody would owe us money anymore, right? We're not going to close out the permanent accounts. Okay. All right, so here's another question. Which of these accounts, this is interesting, which of these accounts will show up in the post-closing trial balance? And then they list 5 different accounts. What accounts will show up in the post-closing trial balance?
Your assets.
Assets,
Liabilities,
liabilities,
owner's equity.
owner's equity. Yeah. So utilities expense will not show up. Income from services will not show up. Or sales will not show up. That's another revenue account, whatever. Make sense? You with me? Nod your head. Okay. All right. Let's see here. What are the 3 what are the 3 financial statements that we create, or the reports we create every fiscal period? In order?
Income statement.
Income statement. What is that for? Income statement. Is that a period of time, or is that a snapshot of the company?
It's a period of time.
It's a period of time. It's for the entire month, or it's for the entire year. Actually, be aware of this. The granddaddy of all reports is the annual report. In fact, all the other reports we create, whether it's a 3-month report called a quarterly report or a monthly report, those are called interim reports. Interim, write that down. They are inside of the annual report. A lot of businesses produce monthly reports, and then they just take their 3 months of monthly reports and add them together for a quarterly. Then at the end of the year, they take their 4 quarterly reports and add those 4 together for their annual report. The annual report is the granddaddy of all reports. All the other reports are called interim reports. Okay? All right, let's see. Ooh. What is the third closing entry if, for the period of time, you had revenue of $50,000 and you had expenses of $60,000? Revenue of $50,000, expenses of $60,000. What is the third closing entry? Go. Go.
Is it would be a net loss.
It would be a net loss.
So you would adjust the capital
By?
by how much you lost. So
Okay.
you would decrease your
So how would you adjust it? What would you do? What do you debit?
You would debit your net loss, and then you would credit your capital, and then you get your total.
The other way around. When we have a net loss, we are going to decrease our capital account by debiting it. We're going to debit capital. What are we going to credit? Come on, guys. What account do we use to accomplish the closing entries? The income summary. In the event of a net loss, like I just described, we are going to debit the capital account and we're going to credit income summary. Make sense? Nod your heads. Say yes. All right. If we forget to make an adjustment, what will be the effect on the report?
Overstating or understating something.
Well, what generally would happen? What would we overstate or understate? If we fail to make an adjustment, generally what would it cause the report to be?
Probably overstate your assets.
Yes, or understate our expenses, right? Remember, on the income statement, we don't show our assets. So if I ask you what effect is it on an income statement, you better answer that it's going to understate the expenses. Okay? If we don't make an adjustment for supplies, then we didn't use any supplies on the report. And if we used up $300 worth of supplies, we darn well want to expense that, because we don't want to pay taxes on more income than we actually had. We're almost done here, guys. Income summary. Where do we find the income summary report account? Under what category on the chart of accounts? It's under owner's equity. It'll have a 300 number attached to it. What is the balance in the income summary all month long? 0. What will the income summary balance be at the end of the closing entries? It'll end up at 0. It starts at 0, ends up at 0 every time. Income summary is just an account that we use to accomplish the closing entries. The owner of the business never hears about the income summary. He doesn't know anything about that unless he's an accountant. Okay? What is the last step of the closing procedure? The last step of the closing procedure is to do what?
Close the drawing.
Close the drawing account. Exactly right. Where do we get the information to produce the post-closing trial balance?
On the ledger.
From the general ledger is exactly right. Remember, the general ledger is where we show the balances in the accounts. It's the only place. The only place. So whenever we do a trial balance, no matter what kind it is, we get the information from the general ledger. Fair enough? Okay. A couple more questions. Let's see here. You do know the 4 close. There's a lot of questions about the closing entries. I mean, the last 15 questions of the test. This test sort of goes chronologically through the accounting cycle, interestingly. Everybody here know the 4 closing entries in order, right? We always close what first? Revenue. We always close what second? Expense. We always do what third? Adjust capital by the amount of net income or net loss. And the 4th thing is we always close drawing. If the owner didn't take any money out of the business last month, what do we do about the 4th closing entry? There isn't one. We just don't have one. So generally we have 4, but we always have 3. But we may not have the 4th one. Okay? Let's see. Wow. So if I asked you, let me see. Nope, that's already done. Okay. If I asked you to put in order the sequence of the accounting cycle, could you do that? Very briefly, what would it be? Number 1, source documents, journalizing, posting, a trial balance, worksheet, adjustments, whatever, how creation of financial statements, adjusting entries, closing entries, post-closing trial balance. Any questions? That's the review. 50 multiple choice questions. Use your notes. You can't use your notes on the test, of course, but you can use your notes to study, go through the book, make sure you're familiar. The best way to practice for this or to prepare yourself for this is to finish up that review problem. Okay?